Welcome back to the Macro Gamer channel. My name is Mark Cassingham. Today we're going to get into our weekly numbers. It's Saturday the 10th, or August 10th, and we're going to go over our performance. Remember, we trade 6 ETFs that represent 6 different asset classes. So we have one ETF for stocks, one ETF for bonds, one ETF for gold, one ETF for commodities, one ETF for US currency, one ETF for Bitcoin. And we had a volatile week on Monday. And we're going to go over kind of what happened and how our portfolio performed. So here we are, weekly numbers, week number 3. So this is our portfolio net worth. Currently we're at $98.47 as of today the 10th. This is our portfolio weekly data. You can see our curve here. On Monday we had a drop, big drop in markets, and it wasn't just our portfolio, it was a lot of people. The S&P 500, I believe, came down around 4%. We'll go over that later. We had a drop to the middle of the week, and you see towards the end of the week we recovered. So it's just a temporary drop. So far it hasn't broken, but it's starting to break down. But we've recovered back some of our money lost. So the starting value of the week was $97.32. That was basically right when the crash happened. It was the ending value. And at the end of the week, we're up $98.47, so it recovered. Our money weighted return as of right now is down 0.35%. We had a market gain of $1.15. This is our previous week. This is when we had that big spike up in the middle here. Then we had that crash going into Thursday and Friday, which you can see carried over to Monday. So this is this continuing crash. So it went Thursday, Friday, going down, then to Monday, came down. And then it just started recovering again. So it's a very volatile week. These are our individual slices. So we still have gold at 30%. It's down 0.44% or 0.13 cents. We've increased our bonds to 25%. Previous week it was 20%. We'll go over that. It is down 1.05% or down 0.25 cents. Our UUP, which is our US dollar ETF, still at 20%. It's down 0.15% or 0.03 cents. Our US commodities ETF is still at 10%. It's down 0.47% or 0.05 cents. Our S&P equal weight ETF is still at 10% of our portfolio. It's down 0.10% or 0.01 cents. And our Bitcoin ETF, which is still at 5%, it's up 2.21% or 0.12 cents. So this is our week 3. Here's our week 2. The previous week, you can see, remember we covered this. We had a very volatile week that week because when you see 1 to 2% swings in a week like this, it's pretty big. And on Monday we had a over 1% swing as well. You see though here at the government it was at 20% last week. So we changed that. We upgraded it, or I should say we increased it to 25%. And I did that Monday morning because over the weekend, from that Thursday, Friday volatility, I saw it in the futures market carrying over, where it was down over 1%. So I knew it was going to open lower. So I increased another 5% to bonds. And that day it held pretty good. All my other assets were down on Monday, but bonds was kind of flat. So that 25% kind of saved my portfolio from dropping more. But everyone's portfolio dropped that day. The volatility index was above 66.0. It's only happened like 3 times in the past like 30 or 40 years. So it was really high. So this is week 2 again. So these are the transactions. So on August 5th, that was that Monday morning, I had 2 buys. It was primarily putting 5% into government bonds. So you see that $3.88 here. And we sold some of our Bitcoin. I'm sorry, we bought more Bitcoin at $1.31. Our USC, our commodities, that's what we took down. So you see, originally it was 15% the previous week. And then this week it's down to 10. So I took that 5% out of commodities and I put it to government bonds. So I reduced our commodities position even further and I increased our bond position. Okay. So we also had less than $1 of transaction sales, 22 cents from our US dollar ETF and 44 cents from our gold ETF. So those are our portfolio transactions. So it's primarily moving 5% from commodities to government bonds. And we have our week 3 Illuvium staking dashboard. Still revenue distribution has not started yet. So we still have our stake here. As of recording this, the Living token is around $45. Our value is 1.32 ILV token, which sits at $59.83. So you see everything zeroed out here because we have not claimed any rewards yet. This is still our stake. It is now 351 days till it unlocks. And while it's locked up, any rewards I receive will come into this account. And after that 351 days, I can take out the money because I locked it up originally for 12 months. You can see the waiting of 2. It's been locked up since July 27th. And this 1.32, how much I put into it. Our revenue distribution is still 0. As I said, we have yet to collect. We don't get revenue distribution until the game studio starts it. Hopefully it's soon. We're going to find out, but this is going to be our passive income or our return on investment, our ROI. Both portfolios are ROI, return on investment. All right, so those are our weekly numbers. Now we can go into our charts. So we have our 6 ETFs: gold, bonds, dollar, commodities, stocks, Bitcoin. So let's look at these on a 1-year chart. So I'm going to extend out my lines a little bit. Every week I'm going to extend these out little by little just to see if the trend continues. So gold's still in a good uptrend since October of 2023. So it's been a great long-term hold. This is my main portfolio. This portfolio we're looking at here started July 22nd. So it's only since right about here, kind of where the spike line's at. This is basically where we started with our portfolio. So, but this overall trend has not broken yet. So it's been good. That's why this is 30% of our allocation to our portfolio. Government bonds, remember we increased it to 25. So you see on this chart, it was coming into this wedge pattern. And then it broke out through here. Now it kind of pulled back. We'll zoom in a little bit on that. So it kind of broke out of this trend and then it dropped down. This was that volatility. So this is the 5th, you see, August 5th, you see at the bottom, this little gray area. This is Monday. So Monday hit, boom, these things started coming down. So 5th stayed kind of flat, like I said. You can see as I move it from left to right, it stays the 5th, then the 6th, 7th, and 8th, it dropped. So it held flat during that very volatile day, and then it sold off. Gold, you'll see, also sold off. So here we are, 5th, right about here. This is the 5th, and then it dropped down. Now normally you think you wouldn't sell gold in an environment like that, but again, it was extreme volatility. I think people were scared, so they just sold what they had. But gold's still in this strong uptrend, so we're not selling more. Our US dollar, you can see same thing, had a wedge pattern. It's very similar to bonds, has this wedge pattern, and instead of breaking up like bonds did right here, the US dollar broke down, came down out of this trend. So if we zoom in, we'll go 3 month. You see it came down pretty hard. This was August 5th, right about here, and then going down to Monday, then came back up, so it recovered. So we still have 20% of our position in this. I haven't yet decided to reduce it because this volatility we're seeing, I think it's better to have a bigger position in dollars just in case, versus it being more risky in like commodities or dollars. Speaking of commodities, this is our USCI, so it's our commodities index. So as you can see, since December 23, it was up in this uptrend, and then it broke down. So these trend bars here, you know, they're no longer it's following it. Broke down right here. So if we zoom in some, we can see it's where it came down. So we're already down to 10% commodities in our portfolio. So I don't know if this will recover. If it does, I can see myself increasing back to commodities. As of right now, I've seen inflation and numbers coming down for commodities, so I think I'm just going to keep the position lower for now. Then we have our stocks, our equal weight. We just extend out these bars. You'll see it just kind of barely broke this position, but it kind of recovered, started coming back up. Now this, of course, right here, August, let's see where we're at, 5th, right here. So this is where it came down. This was, you know, like the Black Monday, essentially. It dropped like 3 or 4%. We actually go to our, where's it at? Our SPY, we'll see that it's actually on here. So, right. So this is basically the 31st. And then it drops down. We can measure this, see what the percentage. I'll put it right about here. Drop this right about here. So we lost about, see that's right about 7%. Right about 7%. This is just in a couple days. Market dropped 7%. Now, normally, if the market drops 7% in one day, it might be a little more, but in one day, it's a circuit breaker, or it'll trigger a circuit breaker, which means trading will stop for 7 minutes, so nobody can buy or sell. So we had that over a couple days. So Thursday, Friday, and then Monday. And then it bounced and it started recovering. So this was a very volatile day. And that directly corresponds with our VIX. With our VIX, this is a crazy volatility. So you had this huge spike. So the previous week I was talking about, wow, this is crazy. It jumped up above 20 and went to just about 30. That was huge. Well, shit. Look what happened. It dropped down. This is August 5th. Here comes Monday. Boom, all the way up here. It peaked right around 55, almost 60. Insane spike. Look at this. Look at this. This is why the market crashed on Monday. Right there. Look at that volatility. That spike is completely vertical. It's pretty bad. Right? So that was what was happening with our portfolio, our RSP. Now we're equal weight, so our hit wasn't as bad. Like if I see if I put on 1 month, and I will measure it. So we'll go right about here. So we're equal weight, so it's 5.7. So your main, the main S&P is about 7%. This is about 5.7, so a little bit less. Still down though. All, like I said, everything came down. Everything. It was a bad day. Right? And then Bitcoin, obviously, going to be the most volatile. We're on a 1-year chart. We had this uptrend, then it broke out. Extend these out just to kind of show that. So it broke out, fell out, but then started this other uptrend, and look what happened. It fell again. Look at this. It falled, then it falled harder. Look at it on 3 months. Look at this trend. Look at this trend. Let me measure that out. So we peaked right about here, came here. That's 30% right there. 30%, 3-0. Could you imagine if your portfolio dropped 30%? That'd be horrible. My portfolio dropped like 1%, a little over 1%, because we're diversified. I don't like that. And I'm like, dang, it's not fucking 30%. That's a big drop. All right, so Bitcoin is very volatile. That's why we have it at 1% in our portfolio. Let's see how much it dropped just on Monday. Let's see. Is this Monday's drop? Yeah, right here. This is just on Monday. Just on Monday. So it dropped almost 20% on Monday. 1924 dropped almost 20% in one day. One day. Remember I said the S&P triggers a circuit breaker. It's 7%. This is almost 3 times that, and it did it in one day. So Bitcoin is very volatile. It can be very volatile on the upside, but it's also very volatile on the downside. So what do we learn, right? Volatility is very scary. When you hit volatility spikes like this, it gets really bad. So the most previous one where we had a volatility spike, we'll put a, let's see, where's a horizontal line? Put a horizontal line right where that peak is. So let's put it at about 65. Let's see, right about there, 55, 65, what I was saying earlier. So in a 5-year, let's look at the all. So this goes back again to 1990, January 1990, right? So you're talking over 30 years. It's only touched this number, and we'll put it down to about 60. We'll even bring it lower, right? Just because we like round numbers, make it easy. So it's broken through 63 times for the past like 35 years. Once on Monday, like literally just this past week. Once January, not January, a little further, May of 2020, actually April of 2020. This was the COVID pandemic, but this is when it just first started going down. And then once in November of 2008, this was the housing crash. This is the great financial crisis. All other times it's been below. All this has been below. All this has been below. Even during the dot-com, it's been below. You know, we have not seen volatility this high for a long time, decades, right? Plural, decades. Right, so that just shows you how volatile that day was. So like I said, when I lost money, you know, a little over 1% barely. The market came down 7% in a few days, 4% just in one day. It is an extremely volatile day. So what else happened that day? Well, a big part of it, people are saying, is because Japan had a big drop. So if I can find, okay, this is only since 2017. Can I get a better one? There, let's go back to the 1950s. So this is Japan, their index. So this is the equivalent essentially the equivalent of an American S&P 500 index. This is Japan's Nikkei 225. Right, so this is their index. So they peaked back in December of '89. This is when everyone was like, Japan's taking over the world type shit. Like they thought they're going to be the biggest economy. And then they hit inflation, stagnation, deflation, just all this bad shit happened. Big scoop down here, and now they came back up here. All right, so I got a 1 year chart. Look at this right here. Look at this. Look at this. Look at this huge fucking drop. So this is July 11th. This peaked July 11th. All right, they've had a huge sell-off. Now, what happened recently? If we go to, where's August 5th? Here's that Monday. Let's look at that Monday. At about here. So from here, right there, to here, Monday, dropped about 12%. 12% one day. Now, I believe it triggered not one, but two circuit breakers. I could be wrong on that, but it triggered a circuit breaker on its market. The S&P 500, the American stock index, didn't, but Japan's did. And this is a big reason why there was a sell-off in the American stock market. Because Japan is the third largest economy in the world. So even though it happened in another country, it still affected global markets. So there's a lot of people stating that, people borrowed in yen. Best way to explain that is they took their currency, like if I took my US dollars, I traded it for Japanese yen, and I wanted to use that yen to buy assets. The reason why I would do that is because the American dollar right now is tied to a higher interest rate than the Japanese yen. So this is the American US dollar Fed funds rate. So we've had a high number in the past 80s, but here we are right now. Zoom in. So this is the 2021, 2022, and then right here, February 2022, we started raising interest rates. And this is because inflation was rising. So now we raised it to over 5%, right? But the Japanese yen, they were in a zero interest rate environment for a long time. So people traded their dollars at higher interest for a low interest yen and bought assets. So they wanted basically cheap debt. But then Japan started to increase their rates, and there was that market crash. So I've heard people label it the Japan or the yen carry trade or the Japan carry trade. Basically, just Japan started raising interest rates. We've already been raising interest rates since 2022, so this isn't new to an American like me. Like we're in this environment, for over 2 years. So like at some point this is going to come down. If you look at the past, they manipulate the interest rate up and down, up and down, up and down, up and down, up and down. All right, so at some point it's going to come down. I don't know when. Nobody knows when. We're just waiting. But that was a big issue with that. So in that environment, when rates drop, you look at your bonds. This is the 10-year yield curve. This is going back to 1913, long time ago. We were in this long, zoom in right here. So we hit this peak in the 80s, and then we're in this long downtrend, right? And as it's trending down, you can look at bonds trending up because they're inverse of one another. So the government bond was trending up. So we had this trend coming up here. Actually, let's look at a better version. Let's look at more index. Here we go. So this is TLT. This is 20+ year treasury bond. Get rid of this. So we were in this long uptrend for many years, like early 2000s, going up, going up, going up, going up, going up. And look what happened right around here in the 2021. Going into 2022, we started raising interest rates, and bam, started crashing, right? So bonds and yields are inverse of one another. So you can have your bond price go up and your yield interest go down, and then vice versa. If your yield goes up, your bond price goes up. So we're in that high interest rate environment where bonds are going down. I think there may be a reverse happening, fingers crossed, but we're going to wait and see. Now, the only other thing I want to cover in this is jobs data. I like to follow, pardon me, the continuing unemployment rate, the continued claims. As you can see, it's been in this uptrend since June 22nd. A lot of people say, once we hit big spikes like this was COVID, so this is April 2020, we had over 20 million continued claims, and initial claims was like 70 million. If you look at all time, nothing compares to the COVID pandemic. It's crazy. This goes back to the 1960s. Because every time there's these big spikes, these big spikes here, is usually followed with like a recession. So like early 2000s, the dot-com bubble here, then the 2008 financial crisis, the fucking goddamn pandemic, this huge spike, and then we're starting to come up a little bit right now. So we don't know if this is going to continue. If it does, that's not going to be good. Another metric to look at is non-farm payrolls. So at the same time as unemployment's going up and this number's going down, this is new job creation. So if new job creation goes down, we're at 114,000. Let's say it goes zero or negative, we're negative job creation. So that means we're either firing, laying off, whatever people at a greater number than we are creating new jobs. So if this number continues down and this number continues up, that's going to lead into a recession. It's not going to be good. So I watched both those. The only additional one I would point out, and I talked about this the other week, was the yield curve. Basically, when it inverts, that's negative. It's recessionary. So if this is recessionary, this is recessionary, 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 almost recessionary, but we printed a bunch of money. The Federal Reserve printed a bunch of money. And here we are, it's recessionary. So when it spikes up, these big spikes, that's when you know you're in it. When it spikes up like this, that's when you know you're in it. So you'll see that in correlation with negative job growth coming down, so less jobs creations, and unemployment rising. Right? You'll see those indicators come up together. So I'm watching all those things. Monday was just kind of a flash crash. We don't know if it's going to continue. More data continues to come out, not showing good numbers like job losses. I know like dailyyjobcuts.com is a good way to track people losing their jobs, and like you see, it's kind of a lot happening, especially in the tech industry. But this is just our week by week analysis. We're going to follow up again next week, do the same thing, go with the same numbers, and we're going to see how this goes. So thank you for watching. As always, if you want to comment, ask me any questions, criticisms, whatever, I welcome it. So thank you for watching and have a good day.